Thanks everybody for coming to our panel this morning. My name is Andy West. I'm a director at McKinsey & Company here in Boston. I lead our transactions practice globally, which includes all M&A, divestitures, joint ventures, and alliances. I have the pleasure of hosting and moderating today's panel. We have four very distinguished speakers with a lot of M&A experience, so I think it will be a very interesting and engaging panel. A few things just to set the tone on M&A. I don't know how many of you have been paying attention. It's actually not hard to see that M&A activity is up considerably. We are nearing the peaks of '99 and 2000 in terms of overall deal activity. M&A activity is up about 35% year on year. Interestingly enough, large deal activity is up over 80%, so big deals are really, really back. At McKinsey, when we look at M&A and value creation, it's particularly interesting as large deals have a very poor track record of value creation. M&A on average actually does create quite a bit of value. We can spend a lot of time talking about that offline, but large deals are least likely to create value. And so you'd expect, the market to kind of react accordingly, but when we look at McKinsey's Deal Value Added Index, which is how we assess investor sentiment around M&A, it's actually the most positive it's ever been. And when you look just at large deals, the first time in the 21-year history of our index, acquirers are actually being positively rewarded by the market for announcing deals, which is, like I said, the first time that's ever happened. Usually the company being acquired has a positive outcome. So the market's supporting the moves. There's a lot of M&A happening. Divestitures are at an all-time high as well. And the mix of divestitures in return relative to all M&A activity is holding its own. Usually you see a dip in divestitures as M&A activity picks up. So it is a unique time for deal making. We're going to spend our session talking about how companies evolve with M&A. It is a very important component of most companies' strategy over medium to long periods of time. We have four speakers. First, let me introduce Ed Lang, who's immediately to my left. Julie Bradley from TripAdvisor was originally going to be our speaker. She actually has pneumonia, so she asked Ed, who's a member of her team, to step in. We're all hope she does well and not shaking hands out here with pneumonia. She's being very conscientious. Ed actually oversees M&A and corporate strategy and strategic partnerships for TripAdvisor, which has been very acquisitive over time. Before he went to TripAdvisor, he was at BlackRock and his PE group doing a lot of restructuring and deal work. So he's got a nice, rich history of deal making that he'll bring to the discussion. We also have James Disney, a little bit farther over to my left, who's a managing director at Credit Suisse. He runs Credit Suisse's East Coast software and mobile payments coverage in Credit Suisse's technology investment banking franchise. He has completed over 50 IPOs and equity offerings. He's done over $50 billion of M&A transactions for buyers and sellers, and over $40 billion in LBOs and private equity debt financings, including three of the four largest high-tech LBOs. Craig Safian is the CFO from Gartner. Craig joined Gartner in 2002, and he was appointed CFO this year. He's held numerous positions, including leading global finance strategy and corporate development. He's also been the managing vice president of financial planning and analysis. Prior to Gartner, he was at Headstrong, which is now part of Genpact, and Bristol Myers Squibb, as well as an accountant for Friedman LLP. And last but not least, David Zinsner, also to my left, who's the CFO of Analog Devices, just south of us here in Boston. He's been the CFO and vice president of finance for 6 years. He's done a lot of different things in his role, including managing the assimilation of many recent acquisitions. Previously, he was at Intersil, where he also covered accounting, finance, investor relations, treasury, strategic planning, corporate M&A, and IT. So we have a very, very rich set of experiences that we can draw from. I would encourage, it's a big group, but I would actually encourage questions and answers during the session. I'll spend some time at the end, but as interactive as it can be, I think it's going to be much more fun and informative. I'm going to kick off by asking each of the folks to my left to spend just a few minutes talking about M&A, their experience in M&A, and how their company is using M&A today to provide a bit of context, and then we'll get into a dialogue. So thank you again for joining, and let me kick it off with Ed. We'll just go left to right. Why don't you start talking a little bit about TripAdvisor?
Great. So I think everyone probably knows TripAdvisor as the global travel brand. Most people probably do not realize how much money we make or that we're profitable. But we do make a lot of money and we're profitable. So M&A ends up being kind of a large part of our strategy. We have done over 10 deals over the last few years since we spun from Expedia, and we really focus on M&A as kind of an accelerator to our core business, which is growing quickly as well. So, whether that's expanding into new areas like restaurants and attractions, where over half of our traffic is, or whether it's trying to expand into new markets from a vacation rental supply standpoint. There are a lot of different areas for us to grow.
Great. Good morning, everyone. I'm Craig Safian, as Andy mentioned, the CFO of Gartner. Our last keynote presenter actually did a really nice job of doing a little bit of a commercial for Gartner with our trademarked hype cycle. But for those of you who don't know us, we are the world's leading provider of research, insight, and advice for the global IT, supply chain, and digital marketing industries. We're a publicly traded company. We'll do about $2 billion in revenues this year, around 20% EBITDA margins, and a roughly, give or take, $7.5 billion market cap. I became the CFO, as Andy mentioned, in June of this year, and prior to that, one of my core responsibilities was running our M&A function. Gartner is, has been, and remains an organic growth story. That is the way we go at the market. That is the way we talk to the market. However, we do use and have used M&A strategically in the past to really augment or accelerate our positions. Since 2005, we've done 7 transactions. So we're not a highly acquisitive company, but we have used our capital to go after strategic M&A, and those transactions have really run the gamut from product extensions, geographic expansions, and acquisitions of technical capabilities. I actually had led those 6 of those 7 deals, and that really means cradle to grave on those transactions from sourcing and identification through integration. And when you do 7 deals over a 9-year time frame, it might sound like a nice, steady, managed pace, and I can assure you it's anything but that. Just like managing a sales funnel or a sales pipeline, you've got to look at around 100+ opportunities to actually close 7-ish deals. It's a little like dating. You don't marry the first date you go out on in 7th grade, typically. Maybe there are some exceptions to that rule. You actually have to look at a lot of things and manage the pipeline really effectively. And deals get hot when they get hot, and they happen when they happen. And my wife often asks me why I plan these things around our summer vacation or the Christmas holidays, because inevitably that's when they have gotten hot. So, back up at the 35,000-foot level for us, we are a growth or organic story, but we do believe that strategic M&A is the number one use of our cash that we have on our balance sheet and our balance sheet flexibility, but we'll maintain a real discipline and diligence around actually doing acquisitions that we believe accelerate our growth and drive shareholder value.
I'm James Disney from Credit Suisse. I've been at Credit Suisse for about 15 years, doing tech banking for all of that time. In our Sydney, Australia office is where I grew up. I do say bar, but I'm not from Boston. In our Hong Kong office at the end of the 90s, in Silicon Valley in the Bay Area, in San Francisco, where I was for about 5 or 6 years, and in New York now. When you think about M&A, it's really interesting. You go through these cycles, and Andy mentioned it at the start. We're in a very interesting time right now. Since the downturn, all of the pieces have been in place for tech M&A in particular to be very strong in each of those years, 10, 11, 12, 13, and 14. But it wasn't really until this year that volumes and deals actually really took off. And there's a few things that are driving that. I'd love to get into it, as part of the panel and our discussion here today. But it depends whether you are a big company or whether you're a small company. And obviously, what drives M&A and why it's important is very different. For the big companies today, you see it in the news. There's really a lot of the large, diversified, incumbent, tech providers and OEMs, are having some trouble. And their best way to get out of that trouble is really through M&A. A lot of the guys who are behind in product cycles or in technologies, are getting in front of some of those cycles, whether it's cloud, mobile, social, big data, through M&A. And on the private company side, it's a great way to exit for a VC-backed company, a private equity-backed company. When we take clients through an IPO process. More often than not, and this happens increasingly, it is essentially a dual-track M&A and IPO process. When you file an S1 prospectus with the SEC, you're kind of, up there in lights for any potential acquirer to look at. And that does generate a lot of M&A activity. So, big companies using it to get out in front of some of these trends where for the most part they're behind. Small companies, they have that opportunity because they are small and innovative and nimble, to be able to help those big companies, fill their product gaps.
Good morning. My name is Dave Zinsner. I'm with Analog Devices. I really cut my teeth on M&A really at Intersil, as Andy mentioned. Intersil was a private equity-backed company. Actually, Credit Suisse was the firm that I might get every one of you guys in a commercial here to help us out in terms of really reshaping the strategy of that company. It was part of a large company that really didn't do much with it, and it was up to us as the management team to kind of reshape it and focus it in an area that we could be successful. And so we did a number of acquisitions. We did a number of divestitures, actually, as well, to really kind of reposition the company into a part of the semiconductor space where we thought we had a core competency and where we thought we could really be profitable. When I came to Analog, I think Analog was known to do the divestiture part, but not necessarily to do much on the acquiring part of the strategy. We had done a few tuck-ins. We had done several divestitures of businesses, and actually Credit Suisse helped us in those, getting rid of those businesses. And so really I came in with the idea that I would kind of help stimulate the acquisition side of the strategy. And quite honestly, for the first 3 years, we hardly did anything. We spent most of the time just trying to figure out what our long-term strategy should be in the semiconductor space. And I think that was key before we could ever even step into doing acquisitions. Over that time, we did get there. And as Andy pointed out, we just closed really our first major acquisition, which was $2 billion. We acquired a company in Chelmsford, Massachusetts. So I think we're off to that being a key component of our strategy going forward, our growth portion of our strategy.
Great. Well, let me start with a few questions, and then please, like I said, those in the audience, just raise your hand. We have mic runners around that can come and bring you the mic. Let's just start thinking about the decision to do M&A. And there are a lot of finance folks in the room, a lot of CFOs in the room. And Craig, you had mentioned this kind of tension between organic and inorganic. And David, you just mentioned the decision to be more inorganic. Talk a little bit about that as your role as CFO. How do you provide guidance to the organization around a healthy balance? How do you get that clarity around your strategy so you can have conviction that the capital that you do have is being directed towards the things that are going to deliver the highest return for the company and for your shareholders? So Craig, why don't I hand it over to you to start?
Sure, thanks, Andy. With us, it's really about ruthless prioritization around what we think are the biggest levers to drive our growth into the future. And typically, those things have been organic levers that we believe we can pull, whether it's investing in more salespeople, covering new hot areas in IT, expanding into emerging markets, et cetera. And so we prioritize those things. There have been lots of examples, though, and I mentioned 7 transactions we've done over the last 8 or 9 years, where we've made the identification that it requires inorganic investment to actually get us going. And there are a few traps from an economic perspective and strategy perspective, quite frankly, that you can fall into. The biggest trap today is the extraordinarily low cost of debt. So every deal pencils out fantastic. It all looks great, right? Is it accretive? Wildly accretive. Does it drive ROIs? Absolutely. But the reason why everything looks great is because banks, and thank you, are basically giving away money, very, very inexpensively. And you do have to challenge the thinking a little bit to look at things in a slightly different way that isn't just, okay, I have to borrow a couple $100 million, that's my only cost. And so I do caution people to not just run the accretion dilution and say, oh, looks great, let's go do it. We make sure that we check all the boxes from a strategy perspective. We make sure we check all the boxes from a prioritization perspective. We make sure we check all the boxes from this will not detract from the core. McKinsey probably has lots of research on this. The biggest mistake I've seen companies make is you just write a check, you spend a lot of money, and you take your eye off the ball of the 90% of the business that needs to keep running. And again, it really comes down to making sure you're prioritizing the things that are most important, while making sure that if you did write a big check, actually going and making sure you get the appropriate returns on it.
Yeah.
Yeah, I would basically echo everything Craig said. Actually, when you talked about the accretion, it reminded me when we were presenting this Hittite transaction to the board, one of the board members said, shit, even a train ticket to New York is accretive right now. So, so basically, you can make the numbers pencil out. I had, right at that point, we had $5 billion of cash on the balance sheet making 10 basis points. So it was pretty easy to make the accretion analysis work. I think that what it's got to start with is your strategy. I mean, you start with a strategy that's really looking, mainly organically at your core competencies, and look out over whatever, a 5-10 year period of what you want to be at that point. And then from that, there should be some piece of that kind of pops out that is we have big gaps. And most of those gaps can even be filled organically and probably should be. But there's probably a few that it just isn't going to work in terms of doing it internally. And I think that's where you kind of come up with the ideas that can make sense, and that more than just pencil out in terms of the financial numbers, but pencil out in terms of why it's going to be additive to the company really on a long-term basis. The other thing I think from my perspective is it was kind of it was either all in or not in. I think that you either make this really a core part of your strategy, you put the structure around it and the people around it to make it successful. You do it on a regular routine basis. You can define what routine is, but certainly at a tempo that allows you to learn from the deals that you did in the past, and what mistakes you made, and learn from those mistakes and improve upon that on a go-forward basis. Because I think if you're going to do kind of a one-off deal and then never do it again for 5 years, then you're really just hoping that you flipped heads when you wanted to flip heads.
Yeah.
Because it becomes more of a luck situation.
Yeah. James, any comments from coming into the transaction that is kind of at least maybe either half formulated, or when you're kind of coming in and people are getting into procurement mode, anything you would add in terms of, or advice you would give to folks in terms of having that kind of clarity of presence and the state of mind around why you're doing a deal, how you're actually thinking about valuation?
Yeah. Yeah, look, I think for clients, for us, most of the time, they have their strategy worked out, or we are working with them to help work it out. It's sort of all around, depends on sort of the size of the company, but a good way to sort of think about it from a framework standpoint is, do you want to use your existing sales force? Do you want to keep your existing sort of solutions? And do you want to just add in some features and some functionalities and do small tuck-ins? And there are a lot of companies who do that very well. For all of the trouble they seem to be having in the press, IBM does that extremely well. Right? Or do you want to sort of add another leg to the stool? And M&A is a great way to do that. And it really depends on a confluence of factors. You need to make sure you understand where are your customers today, what do they like, what don't they like, what are the competitive sort of barriers to entry that are out there. If you were going to enter a new market, how could you create some synergies, strategic synergies, by doing that acquisition. So, it really depends. But we do spend a lot of time, because when you think about it for an M&A transaction, for us and with our clients, it can be 3-4 years of work in some cases. There was one deal that we just completed for one of the big, large, diversified OEMs that I might have mentioned in my previous sentence that took basically 5 or 6 years. And so, that is something that you have to, and the markets change, things change. I mean, what's happening in tech right now, particularly in software, a year is a long, long time.
Yeah.
So strategy-wise, you need to be careful. I think it's interesting. I've got an example of one client who they're a vertical software company. They're really the leader in their vertical. And they've done that through acquisitions. They've done that through multiple acquisitions. And there's basically only small players left. So for them, what are they going to do now? They have to look at a new leg to the stool.
Yeah.
And when you do that, you're willing to stretch on things like valuation that you mentioned. Because it tells a new story, it opens up, new TAM, a different market. It's fascinating to watch, but in today's environment, the size of your addressable market for investors, if you're a public company, you guys know this well, is critical. Mm-hmm. And it's because there's such a huge focus on growth. Yep. And there's really nowhere else to get growth, except in technology, maybe in healthcare and in biotech. And so you've got tech specialist investors who know this well, but generalist investors in the public equity markets who are focused on tech because it's the only place they can get growth.
Yeah.
And you mentioned it before, the guys who their stocks are going up, who are acquirers making big acquisitions, sometimes at huge multiples, much higher than their own company's multiples, very multiple dilutive in that way, and are being strongly rewarded by investors. And it's because they've all built up cash. The top 20 tech companies today can probably buy the next 100 with the cash balances that they have, right?
Yeah, and that gap has actually been with excess cash.
Yeah.
We've looked at that. I mean, there's enough excess cash in tech for the mega large cap companies to buy all the small and mid cap companies combined. Right?
So if you're a shareholder and they're saying, you're going to return cash to me, I'd like you to do that. Don't buy back your stock. Don't give me a dividend. That signals that you've got nowhere else to go. Go and buy something.
Yeah, yeah. Let's talk a little bit about growth-focused M&A, and Ed, I'm going to come back to you. You guys do a lot of IP-based and talent-based acquisitions, right? So how do you think about that, right? I mean, this is, you guys are buying, you've done a lot of deals, a lot of smaller deals. How do you think about valuing them? How do you have that discussion within your organization to make sure you're going to get your money back? How does that tie into your strategy?
Yeah. So valuation is tough on the small deals just because, a lot of things, you're paying just to be able to hire the team in a lot of cases. Mm-hmm. But the way we think about it is, we're just trying to accelerate some part of our roadmap. So if there's a function or feature that a small group of people in Palo Alto have been focusing on building for, the last 3 years, we could put 2 or 3 engineers and a product person on it and build that same product. But it might take us 6 months. We'd probably get to version 0.5 where they're at version 2.0 or 3. And it really just allows us to kind of continue to move quickly and get the features that we want in our products or on our website. Yeah. So we've done kind of maybe 5 or 6 acqui-hire type deals, and each one is pretty small compared to the size of our business, and so we do them quickly. I think one of the things that's key with that type of transaction is to not spend many years focusing on it. You need to be able to pump them out quickly. So we do kind of a 30-day timeline for most of these deals, and that's allowed us to go quickly, get another one on the docket, and also keep the entrepreneurs focused on what they do best, which is build cool products.
How do you as an organization think about risk, given that volume of deals and the fact that the ROI is hard to measure and to manage over time? So I've seen companies, for example, just become completely frozen. They need to do 10 deals over a course of a year, similar to your strategy, just to keep their features and stay relevant in the marketplace. But the second one goes wrong, and now it's the game's over because you can't do it, or that particular deal didn't fare particularly well. So how do you guys think about that?
Yeah, so we look at all of our kind of M&A as on each deal we look at the success metrics for each one, and we judge that and decide we learn from it. But we look holistically at M&A is a core part of our strategy, mm-hmm. and if we do 14 deals or 10 deals over a time period and one doesn't work out because we didn't make a good enough 180-day plan for them or something like that, we don't get hung up on that. We continue to go. We've had enough successes that we know that there's always another deal that we can go on.
I have a question in the front.
My name's Matt Budd. I chair the Financial Executives Networking Group. The rumor has it that most deals don't attain their value. So my question is, where does the greatest success come from? Does it come from being proactive and looking out in your environment for companies to acquire, or from examining the deal flow that other people bring you?
Well, I'm so glad you asked that question. It wasn't really a plan. I think let me address the first part, and then I'll ask the panel to maybe talk about proactive sourcing and how do you think about getting the right targets and the right deal flow, because that is a very important component of value. About 2 years ago, McKinsey, we re-looked at this question, because I don't know how many people have heard 2/3 of deals fail or 70% of deals fail. It's kind of like common knowledge. It's just not true. I can't say it more clearly than that. No, it's actually much. Is it worse? Was the question. The answer is actually no. And if you think about it, it's actually much better. And the reason why that data is out there, not that the data is necessarily wrong, but the only way that the only way that M&A performance has traditionally been measured is by stock price movements before and after a deal is announced. So most of the academic research and consulting research, including previous McKinsey research, has all been about announcement effects. The problem is only 1% of deal volume is large enough to actually merit a change in shareholder value. So all of the work that you've seen, all of these rules of thumb are based on this 1% of very, very large transactions. 99% of deal flow, in terms of the companies that we're talking about that are actually making up most of the market, are small deals. And when you look at the entire data set, we've done this painstakingly, actually on average companies outperform using M&A over a 5 to 10 year period, looking at their total return to shareholders, excess total returns to shareholders. So, and the reason is it just makes a lot of sense, right? Very few companies are in a position where organically you can place enough bets over a 5 to 10 year period to deliver your strategy. And that's kind of the punchline. Now, there are a lot of things about how do you build those capabilities, but I appreciate the opportunity to dispel the, deals are a failure. It's actually quite advantageous to consultants because it scares everybody and then you need help, right? But be wary, because everyone does M&A. When you look at the 1,000 largest companies by market cap in the world, there are only 2% that have followed an organic strategy over a roughly 10-year period that have survived in the Global 1,000. So it is a big part of company strategy and long-term survival. But let's talk about sourcing. I think that's actually a good question, and in particular proactive sourcing, because getting out there and having conversations with targets is
Always examining your environment.
Yeah, exactly. Constantly proactively examining your environment. So let's talk about finding the right targets. David,
Yeah.
do you want to talk about that?
Sure. Because I think it's important. With all due respect to James, I do think that when the banker brings you the deal, generally it's a dog.
Yeah.
No offense.
None taken.
James, you're next, so you can prepare a rebuttal.
Thank you for that, Andy.
You can get them later and then have them help you. But I just think that you got to get out there, have a good universe of, or good understanding of the universe of what's out there. And to do that right, you really have to do it yourself, I think. And that's, again, why I say that you really want to go in there with eyes wide open in terms of doing this, because it is a lot of work. You have to spend a lot of time with small companies, meeting their CEOs. You have to spend a lot of time with venture capital firms, with the private equity firms, getting to know what they have in their portfolios. You spend a lot of time with larger companies, maybe even larger than you are, talking about what assets they might have that are not necessarily strategic in their portfolio. And 99 times out of 100, it goes nowhere, quite honestly. But it helps you pull together the pieces of the marketplace. And at some point, one of them says, you know what, maybe this is the time. Let's talk. And that's the way the deals get done. And I think in every case that we've acquired a company, that's how it started. Somehow we had a relationship with them. They picked up the phone, or we picked up the phone and said, hey, would you be interested in talking about something more strategic? And eventually, in certain cases, it's kind of worked in our favor from an acquisition perspective. Then we hired James, and then James helped us, like in the case of Hittite, acquire, do the analysis and execute the deal to make it happen.
You can't underscore how important it is to cast a very wide net on these things. So we have an internal competitive intelligence team that monitors the market, which is a good first start. But you do need to build a network with bankers. You do need to build the networks that David talked about with small companies, large companies, VC, private equity. The thing, when I was running M&A, the thing that kept me awake at night was an asset trading without us getting an at-bat. And I know my CEO would, not be happy, I'll say it diplomatically, not be happy if we didn't get that opportunity. And you've got to plant a lot of seeds to make sure that you don't miss those opportunities. And so part of the corp dev function has to be cultivation, competitive intelligence, getting out there and shaking hands and kissing babies if required, probably not, but definitely shaking hands, just so you know the market, and also implanting yourself and embedding yourself with the investment banking community so that if something is going to trade, you get your at-bat, or even if it's not going to trade and it's out there, you just want to make sure that you are, as an acquirer, you are always a part of those conversations. And I can't stress that enough. And again, I don't run M&A anymore. I still lose sleep at night thinking we're going to miss at-bats.
James, what's the best way to use a banker?
Yeah, it's sort of two things. I guess it's three things. One is sourcing, as you talked about. If it is hard, right? It's always a challenge when you go and talk to a company. You want to make sure that you're going to be showing them some acquisition ideas that they haven't already seen. And when they live and breathe what they do every single day, it can be difficult, right? The advantage, that we have as being a global bank is, you can deliver to your client sitting, here in Boston, what's going on in, Latin America, what's happening in China with this particular company, what's happening in, the Nordic region. So sourcing is important, but it is a challenge. What I found really fascinating in the last few years is the bigger companies, and it doesn't have to be huge, $1 billion, $2, $3, $4 billion of market cap, are more and more focused on very small companies. When you think about what has happened in technology, a company can go from zero of revenue to $100 million in 4 years today. It happens a lot. And so what they're really worried about is not knowing what some of the small companies are doing, because previously they could be nibbling at their toe, and if they saw them nibbling, they could squash them, or they could buy them, or they would just leave them alone because they knew that they could ultimately win. Today, you may not feel that person, that competitor, nibbling at your toe until they're up at your knee, and that's very scary for larger companies. So for us, sourcing is very important. We have had to, and it's fascinating and frustrating, to watch, had to have a relationship with more and more companies on an earlier stage. So seed round, VC round, Series A, if you are not, investing time knowing those companies, then you can't really bring value to your larger clients, because that's what they want to know about.
I mean, the one other thing I'd add is, for the acquirers to leverage the expertise and the network of bankers and VC and PE, is you need to be able to articulate what you're looking for.
Yeah.
It can't just be, we're interested in acquisitions. That's of no use to James or anyone in that space. If you can be somewhat crisp and articulate about what it is you're looking for, what are the gaps you're looking to fill, what are the geographies that are of most interest, what are the technologies that are of most interest, that's going to drive a lot more valuable conversations from a sourcing perspective.
Ed, let me ask you one question on sourcing. You guys find a lot of these small companies, like the very small ones. How do you do it?
Yeah, so most of the time it's leveraging internal teams. So we have different groups that focus on vacation rentals or focus on our core product or restaurants, and those guys know the industry like the back of their hand. They are the ones that are out there, day to day, getting calls about partnerships or getting calls from random companies because they're competing with each other. And those we really leverage those teams to identify targets and interesting high growth companies or people that are competing or that are in areas that we're just not in, from a geographic perspective. So
I was just saying, how do you manage just the random inflow of ideas as a team and as a leadership team? So you're not chasing down everything. So it sounds like you've got a lot of hooks out there looking at these spaces, but how do you separate good opportunities from bad as they flow in from the field or
a lot of late nights. No, I do some screening. We'll get companies that reach out to us constantly, and our team will screen them and then send them off to our individual business leads to evaluate them. Or we've worked with most of them at this point that I can pretty much say yes or no as to whether they would be interesting to them
Yep.
up front.
Great. A question here in the front.
Okay, thanks. Dan Allred with Silicon Valley Bank, and my question is, how do you guys think about buying a team versus buying technology versus buying a business? And I guess where are the break points? How far up will you go in terms of value, and how much, as you're thinking about that, do you care about the preference stack and what VCs have already put into it, or you just disregard that and put the price that you think matters?
Yeah.
Great.
So
You want to start that, and
Yeah,
then maybe
sure.
you and Craig can both answer?
Yeah, for us, there's when you're buying a team, for us, we're not interested in spending a ton of money up front. I think when you get a team, what you're looking for is to get some people that are going to build some really great products and features for you, and so you're interested in paying the money over a course of time. Other companies have different philosophies about that. I'd be interested to know how you guys feel, but. For the teams, we wouldn't pay very much. Anything kind of, above $5 or $10 million, you start talking about, it needs to be a real business. It needs to have revenue. It needs to be able to generate revenue and grow quickly and have potentially high margins in the out years.
We're an intellectual property business, and so in essence, every acquisition we do is driven by the human capital that we acquire. The assets, in essence, get up and go home every night. And so we've got to pay great attention to make sure that we protect those assets, just like any other acquisition, whether it's patents, trademarks, a technology, what have you. We have to view the people generally in our acquisitions in a similar way, and make sure we put in incentive structures to ensure that those assets don't leave or just fall through your fingers. On the valuation side, to be frank, don't worry too much about the cap table. Want to know it, obviously, want to know who's in it, but it's not my job to drive returns for VC or angel investors or what have you. My job is to get the best deal for the best value for our company and our shareholders. It obviously does play in quite a bit. And there's obviously a lot of posturing as well from those investors, from the board of the target organization, et cetera. From a valuation perspective, we talked about this a little bit earlier. If the best analogy I can use that someone very smart told me once, and it was about buying a home. If you love the home, if it's beautiful, if you can envision raising your family and just absolutely loving it, you can stretch a little bit on valuation. Same holds true with corporate M&A. If the asset is strategically checking every single box that's really important, if you could see huge synergies coming out of it, if it's a strong leadership team that you could see really thriving within your organization, you can flex. If you can't check those boxes, you have to be a little more circumspect about how you think about that valuation.
One thing I've noticed, your question about teams is, particularly in the Bay Area, right, where competition for talent is very hot, and it's more and more so in the Boston area too, is when they're trying to go buy a team and they trust the team, they like the team, it will fill a gap for them, they can do something with it. I've seen prices per engineer, and it's typically engineering talent, per engineer that range from $500,000 to $3 and $4 million per person for a team that has very small amount of revenue. So you've got 10 people, could be 10, could be $40 million, which is extraordinary, and those numbers have gone up a lot over the last 5 or 6 years.
Did I see another question over here? Just wait for the mic. So you can all hear. And those of you that are on this side, really raise your hands high. I have a hard time seeing what you're
I thought to raise my hand high.
Thank you.
Thank you very much, by the way, for coming out and spending some time with us here at this event. My name is Dennis Ringland. My question is, and I'm pretty sure that all of you are exceptions to the rule, but Every now and then, I'm sure a deal goes south, goes sour. Um, can you address some of the reasons why a deal might go bad and what you've learned from that, and if there's any strategies that you employ now to avoid some of those landmines?
I could start, actually. I'd tell you the major one. We're an engineering company at heart, and so processes we're really good at. So, we go in, we do the due diligence and come up with, how we're going to integrate this thing and map out the processes, and we do it marvelously well. I mean, and it works like clockwork. And the thing that, even at Intercell, we always missed was making sure culturally we had the whole thing lined up. I think generally, at least in tech, what normally happens when a deal doesn't work out is you get these very entrepreneurial people who are bootstrapped, working 18 hours a day for the love of this whatever, And then they get into the, gigantic company with all the bureaucracy and, now being told what they can do and they can't do and, where they can, book a hotel. There, I booked Work TripAdvisor in there too. And they get pissed off really quickly and they go, I'm done with this. And so first you have a 1 year of absolutely no productivity and then they're gone. Mm-hmm. And so in the Hittite acquisition, which is a little different because it was a bigger company, but I think something we'll employ even when we're doing the tuck-ins, is we did an actual cultural assessment, which, I think mostly we're finance people in the room. We generally poo-poo anything that HR comes up with. And in this case, actually, I think it really worked. I mean, it wasn't like we had perfect alignment, but we understood where we didn't have alignment, and we thought through exactly how we would map that to make it work in the context of the way we do business. And, it's early, of course, but I think that has made it way more seamless than it could have been, had we not done that.
I think, doing transactions is really hard work, and small deals actually, can be harder work than larger deals. Mm-hmm. And a lot of times after that very intense, very long, very protracted process, the organization sort of falls down in a heap of exhaustion. But the reality is the hard stuff actually starts on day one, and that's integration. And David alluded to it, but I can't stress or underscore enough how important integration planning is, and I can't stress how important running through the integration and making sure that every I is dotted and every T is crossed, because that's where the value comes from. And that's where, in my experience, not at Gartner because we've executed amazingly well at Gartner, but in other organizations, that's where the value seeps out when you don't do great integration. And we've actually baked an integration playbook just from experience on doing the 7 or so deals we've done over the last several years. And we start pre-integration planning during the due diligence phase. And part of that integration is a cultural assessment. Yeah. It is absolutely enormous. And interestingly, what we found is we're typically much larger than the companies we're acquiring. They've typically competed against us, and they have a view that we are the evil empire. And it takes a lot of work to convince them that we're not the evil empire. They may have other names for us, but we'll leave that for another day. But making sure, and when you peel back the onion, we often find that the cultures are very similar. Research-driven, process-driven, methodology-driven, thought leadership, and you find the common ground culturally as opposed to identifying, oh, you get 3 weeks vacation, we get 4. Don't fall down on the differences. Really focus in on the similarities and drive that with the leadership team of the target so that they can drive it down with their teams. But it really is all about flawless execution on the integration. And if you don't have flawless execution, you can guarantee you're never going to get the value out of that acquisition.
Yeah, just to add to that, I think it's really key to get a kind of 90 and 100-day, 180-day, 1 year plan in place of what they're going to work on and how you're going to prioritize projects from that company or from that team versus the rest of your organization. It's one of the most important things, I think, to making sure that they stay engaged and that they don't focus on the little things like, oh, we used to get Fridays free lunches or something.
There's one thing I just want to mention too, and I would absolutely agree. It's really all about the people. We have one client that we took public about 4 years ago, and they have done 45 acquisitions. It's an absolute acquisition machine, and their organic growth is between 5 and 10%, and they will acquire another 10% of growth, revenue growth, every year. And because they've done so many acquisitions and they have a playbook, and they know exactly what to do, on day 1 and day 30 and day 60, 90, 180, and 60, they know exactly what to do. That we were able to get with investors credit for acquisitions that they have not yet done. Mm-hmm. And it was because, they have this playbook, and they know that the people, they can get them to stay, that they can get them integrated, that they know what exactly is supposed to happen at every single day post-acquisition, which was pretty unique. It was not easy to do. It's because they have this playbook.
One more thing, sorry.
Yeah, good topic.
We acquire a lot of companies that are very entrepreneurial, and we're very entrepreneurial, but we're bigger. We're, I think our CEO likes to say, we're a startup that just happens to have over 2,000 people. And one of the things that you need to figure out when you bring in an entrepreneurial team is how do you let them continue to run fast and do really interesting work without having them get bogged down in the bureaucracy, and so that's also part of kind of the 180-day plan.
Yeah, I would build on that. One of my biggest triggers for having a real concern about one of my clients' deals is when they buy an entrepreneurial company and then they say, we're not, because you just said you have this plan, right? So, well, we're not going to do anything with it because we don't want to mess it up. And not doing anything with it means you're leaving integration decision-making to 2 or 3 levels down in your organization. And what you're going to end up with 18 months later is an unintended integration driven by accounting and driven by HR and the benefits coordinator in HR and your procurement department. And so be very careful about that, being purposeful about the target in terms of culture and in terms of how you integrate them is extremely important, and do not fall into the trap of, well, we're not going to do anything because we don't want to break it, because that will, I guarantee you will break it. So being very thoughtful about that is important. I want to ask one question just about, we've touched on it, but about perception as an acquirer, right? I have seen, and I think, David, I'm going to turn it over to you after this, because you told me an anecdote that's similar. Companies highest bidder lose deals, right? You lose it, you're the highest, because you are the evil empire, or because you were seen as highly bureaucratic. How do you think about that? How important is it to manage your perception as an acquirer, and how do you do that to drive good deal flow and to increase your win rate?
Yeah, I mean, Andy, as I was telling you the story, I think this was 3 or 4 years ago. We're looking at a company. It was in the kind of Europe area, and we put in a bid that was, I think it was maybe 15% higher than the other bidder. And they said, no, we're going to go with the other bidder. And at first, we were completely dumbfounded about this. Who actually makes a decision like that? But I think in reality, what they were mostly concerned with was that not necessarily that we were the evil empire, but that we had no experience in it. And I don't think they liked the idea that somebody that didn't know what they were doing was going to take their baby, bring it in, and screw it all up. And so, I think we learned a lot from that, in that we had to start a little bit of a track record and a little bit of, I think now more than ever, when we go and talk to companies that we're looking to acquire, we either on the front end or the back end spend a good 2 hours giving them the Analog Devices pitch about what we're all about and what we're excited about and why we think this might work for us, and almost selling them more than they're selling us in terms of the transaction. And I think that has helped, although the proof will be in I think as we get more routine in our acquisitions, I do think that people go, oh yeah, these guys know what they're doing, they do it all the time, they're very successful, and when you talk to the people in the company that were acquired, they generally have good things to say. But I think to start with right now, we're in sell mode, that we can actually do this and make you, the target, better by coming into our, because there are, the VCs will certainly have a major vote in this, and depending on how powerful the VC is, it may not matter at the end of the day anyway. They may just go with the highest bidder. But even if you do win it and you have a bunch of people that are kind of, chances are they're going to be out of there pretty quickly. And as we all pointed out, most of the time it's about people that you're acquiring anyway. And when they walk out the door at whatever time at night, and then they don't come back in the next morning, then you've just flushed all that value down the toilet.
Yeah.
The social elements of deal flow and deal making are enormous. And we talked earlier about driving relationships at the CEO level with hundreds of companies. And one of the benefits of doing that is you can actually start the selling process of why we're a great place for your company to be during that first introductory lunch or dinner. And making sure that you address all those social issues up front. So sit with the CEO. I mean, one of the things we do is even on really relatively small transactions for us, our CEO is at one of those initial meetings because we want to show this company we are absolutely committed to making this work. And in fact, decision making is at the highest level of the organization. And that goes a long, long, long way in terms of driving credibility and forging those relationships. And knowing that if there's a hiccup during the process, that individual can pick up the phone and talk to me or talk to the CEO, in a sort of unguarded moment because there is a pre-existing relationship, as opposed to it's all been dealt with 4 levels down in the organization. There is no recourse, kind of screw you guys, and that's it. And so driving those social relationships up front and continuously throughout the process, absolutely enormous, and actually really do grease the skids in terms of doing good deals.
We have about 6 minutes left, so I want to give a chance if there are any topics we haven't covered. Okay, I'm going to do a few questions and we'll close. So there's one over, wherever the microphone goes.
My name is Davida Howard. I'm CFO of a company called Trend Nation. I'm coming from the opposite end. We're a fast-growing company, very profitable, looking possibly to sell to a larger company. You already told me that banks are dogs, or they bring in dogs.
None taken.
No offense taken to anybody. So, as a company, who should we partner with? Who should we strategically try to partner with in our quest for a sale?
That was going to be my closing question. Have each person say what advice would they give to the community about being acquired?
Right. I mean, is VC my only option?
Right. Okay. Well, we will. Let me see if there was one more question, and we'll use that as our closing. I'll have each person give a bit of advice. Was there one more question? Or I saw somebody had a question over here. Maybe it was the same. Same question. Okay, perfect. I think it's a great question. So let me just start, Ed, with you, and why don't we just go down and everybody spend a minute or two. Advice you give to companies that are on the other side that are looking to be acquired based on your experience.
Yeah, so just recently at a conference, our Barry Seidenberg, the CEO of Viator, was on a panel about M&A, and what she said I thought was good, which is, you do need bankers. I think if you're a large, growing, and profitable company, or small but growing fast and profitable, you can choose whatever time you want to sell, but having a banker on your side is helpful, but you probably already knew who you were going to sell to in the first place. So you should have the relationships with a whole bunch of companies. You bring in the banker to manage the process. They know what they're doing. They are extremely good at executing the deal, and they probably will get you a better price. But you want to be in a situation where you can choose to go with the company that you work well together, you have a cultural fit, you see the synergy opportunity, even if it's a little bit less upfront potentially. You should probably already know those people. I don't see many deals where people buy a company that they've never met before.
It's funny, the comments earlier, about bankers, and thankfully James takes no offense at all these jabs at him, was from the acquirer's perspective, because I know for at least us, we are generally not using a banker on the buy side, and it would be great if there was no banker on the sell side. So that's a very selfish perspective from the buying company. I think the comments just made are spot on in terms of running one of these processes, whether it's an auction, a modified auction, whether you're looking for VC or private equity, whether you're looking for a full acquisition, and oftentimes, as James mentioned, there are dual processes. So maybe you want investment, but we'll test the waters from an acquisition perspective as well. You need somebody to manage that process. It is extremely time consuming. It potentially detracts from your ability to run your business and continue to drive more value. And so if you don't have someone helping you, it's really going to hurt, both from a value you get on the transaction, but probably more importantly, from the time it's going to take from the leadership team away from doing what they're actually paid to do, which is drive the business. So the only advice I'd give is if you're going to go into a process, you can't really dip your toe. It's not that kind of animal. Well, even if it's just, I want to raise, sell 25% of the company or what have you, you've got to go all in. And if you're going to go all in, you ought to have people who do it much more frequently than you. So, whenever we're looking at a transaction, just as an example, and as I mentioned, we do less than one per year. I have on our board multiple private equity people. I sure as heck get their counsel and advice because they see 100 deals a year versus my 0.7 deals a year. Similarly with a banker, if you're in this process, this is what they get paid for. This is where they drive value. And you don't want to climb Everest without a Sherpa, and you should think of your bankers, good ones that work well with you, that fit from a personality perspective, from a workflow perspective, from a geography perspective, as your Sherpa through the process. It's a good commercial for you, wasn't it?
Thanks. Yeah. Look, I would agree. Look, it's the thing that's, and no surprise there. The thing that's interesting, I think, is it's particularly relevant in software. I worked on a transaction earlier this year where we were representing a company selling themselves. A very good company, in a great space, growing very fast, a lot of opportunity. There were plenty of obvious buyers, and the company knew who those buyers were. There was a whole separate group of buyers who were not in this country that was really a space that was completely adjacent, who would have paid a higher multiple and ultimately did pay a much higher multiple for this company than the obvious people that the company already knew about and had somewhat of a relationship with. And so you got to align yourself with somebody who really knows your industry and has a very broad perspective. When you think about it today, particularly in software, every company is a software company, almost, right? It's almost true. A bank is basically a software company, an insurance company, an automotive company makes cars. It's the value in a car today, for people who are under a certain age is, the electronics that are in the car. A bank's, best channel through which they engage with their customers is via software. And so particularly in software, for software companies, acquirers can be completely off of your radar. They may be, in an industrial space in, Europe that you have no idea about. So, having, somebody that really knows your industry and aligning yourself with them early on, I think is important.
Yeah, I think it will come as no surprise. I was going to say hire Credit Suisse to do it. I would echo almost everything everyone else said. I think that knowing your the universe of companies out there to some degree, whether you actually form a relationship with them or not is a different question. But I do think just understanding who the potential acquirers are. I think thinking a little bit about the strategy of your business and how it might better marry up to some of the companies you might want to be partnered with can help out a lot. So you might want to just tweak some of the obviously you're not going to change your entire strategy, but if you tweak it a little bit to make it more attractive to companies that you want to be aligned with, I think that makes it greases the skids quite a bit in terms of an acquisition.
Yeah, but the only thing I would add to close is just understanding how you, taking the time to build on David's point, to understand how you add value to the company that's thinking about acquiring you. A lot of companies get very much into data handover mode very quickly once your foot is in the water and you're in the process. And taking the time to step back and say, what is it that the person on the other side of the table is hoping to achieve how do I play into that story? And if they don't do the things that our panelists talked about, like express their strategy, communicate to you how they're going to add value, ask those questions, I think it will help you in the negotiating process. It will help build, I think, a healthier bridge of negotiation, even if you're doing that just early on through breakfasts or meeting at conferences and things like that. Just get to know the people who are in your space, cast a wide net, but then be very purposeful, again, about how you present your company and how you add value. So, with that, let me close by thanking our panel. Thank you also for your questions and your time and interest. And if there are any other questions, I think we'll all be around at the conference later today. Don't hesitate to reach out and ask. But again, a round of applause for our panelists. Thank you very much.